Hello again, traders. Doing Cadjpy there from DRFX, Swing Trading Mentoring. Going to be taking a look at a recent trade that was made on the Canadian and Japanese yen, which provided us with a quick trading gain of 65 pips towards the end of last week. Here you can see the 4-hour chart of this currency pair on my live account with FX Pro, where you can see the initial attempt where we attempted to trade the breakout bullish, but incurred a loss as the market reversed instead of continuing the breakout bullish. But as the market reversed and headed back inside of the consolidation, we were able to take advantage of it and capture a 65 pip trading gain as the market headed back toward the support boundary. Now here you can see the result of this trade. On the left hand side you can see the summary of the email alert that was sent to me by FX Pro. And on the right hand side you can see the result of this trade, where you can see that from my personal account, this trade represented a return of 3.13%, and you can see that the trade itself took only 16 hours to hit our trading target. Now this recent trade represented the latest in trading gains since the new approach started in February, where basically you can see that most of the trades have been positive, with a few losses that have been occurred along the way. But it generally speaks to the accuracy of the new trading approach in targeting very aggressive short-term movements that the currency market offers on the daily chart and the 4-hour chart. And so far since February, this strategy has provided us with a rate of return of 13% on my live account, and we're just one trade away from hitting the first target of 14% before moving on to the 30% target, which should be hit after 3 more trades. And thereafter, the target will be these additional large rate of return that should be hit in the months ahead. Now, the trade itself, the daily chart as well as the 4-hour chart of the Canadian and Japanese yen, took the form of a range consolidation setup, which is, as you can see here, is where the market forms horizontal boundaries of both resistance and support. Now, what was taking place was that the market was initially trying to start a breakout bullish, but then reversed sharply and headed back inside of the consolidation. This is what we call a false breakout reversal setup, where, as you can see here in this example, the market initially starts a breakout at one end of the consolidation and then reverses sharply to head back inside of the consolidation to the other boundary. And in most cases, it eventually leads to a breakout that takes place at that boundary and starts a breakout and trend in the opposite direction. So this was the theory behind the trade that was done on the Canadian Japanese yen. So as you can see here on the daily chart. Now, first of all, just to point out quickly that FXCM charts are the ones that I use to identify market direction and entry signals, because they seem to use the most accurate version of the New York close of the daily candlestick signal, which is crucial to trading strategies like mine. So I use FXCM charts because of that, but my live trades actually take place with FX Pro because of the better user interface when it comes to executing trades, such as email alerts, as well as the ability to actually see the exact percentage return and risk that is involved in each trade, so you can be sure that you're not exceeding your maximum risk capital and that you are targeting your minimum return per trade. So back to this chart. This was a setup that was formed on the daily chart, whereas you can see the market had formed a range consolidation setup. You'll also notice that the market attempted initially to start a bullish breakout on 2 occasions with these 2 strong bull candles, but eventually these were taken out by this sharp reversal that, as you can see here, ended the day with a large wick inside of the consolidation and the body outside of the consolidation above resistance. Now, what was needed to provide us with a trading opportunity, as well as to confirm the continuation of this reversal, was another bearish signal that was strong enough that would indicate that the market was indeed gonna reverse and head back towards the support boundary. So this was what was needed. And on the 4-hour chart, what was taking place was that the market had formed a double top formation as part of the start of this reversal. And from the theory of candlestick formation and double tops, they usually indicate the start of a trend reversal. And not only that, they normally lead to fast movements as part of this reversal. So as you can see here, the 4-hour chart actually started to pull back, and what was needed was for the 4-hour chart to also provide us with a signal to indicate the continuation of the movement back towards the support target. Now, candlestick formations, there are hundreds of candlestick formations that you will see across the currency market, but these are the most popular and the most accurate in terms of providing profitable trading opportunities. Double tops here, as you can see, as well as ABC signals, these generally tend to be the ones associated with trend reversals, and usually when you see them appear when it comes to trend changes or reversals back inside of consolidations, they generally indicate that the movement is going to be fast and aggressive. Now, as you can see here, the next day the market provided us with a signal that we were expecting and that was required, and so this was a green light that was telling us that we should now try to look for a trading opportunity to take advantage of this continued bearish movement as it made its way towards the support boundary. So a false breakout reversal setup given and providing us with this entry signal. Of course, it was important that the market actually gave us a signal inside of the consolidation. There are times when the signal can be outside of the consolidation, but in terms of a U-turn and a reversal like this, it was more appropriate for the market to provide us with this single candlestick signal. So to take advantage of this, what was done was to place a stop loss just above the downtrend line, just above this blue counter trend line as well as above the resistance boundary. Entry was going to take place at the close of this 4-hour candle, which coincided with the close of this daily candle at 5 p.m. Eastern Standard Time, and the target was set for 84.15, just above the support target. And as you can see, after a minor pullback where the market provided a brief level of buying momentum, the market eventually continued the bearish movement and hit our trading target and provided us with a 65 pip trading gain. Now, this is why it is very important to have a trading platform where you can simply receive email alerts instead of having to monitor the trade and monitor the graph. Because if you were in this trade and you decided to look at the market after entry, then you would have seen this reversal taking place. And even though these movements and these candles were very weak and really did not provide much of a threat, the natural emotional instinct that we have when it comes to trading is that if we see the market moving against us, our natural instinct is to want to panic and to second guess ourselves and to second guess our decision and to second guess our trading strategy. So to avoid all of that, which can lead us to prematurely exit a profitable trade, it is wise that as soon as you have entered the market, you close the trade, you close the platform, and you simply wait until the market has either come to the end of the holding period, which was in this case 2 days, or you receive a trading alert that allows you to know when the trade has closed. So this is why it's very important, and this is why I recommend that after a trade has been opened, that we avoid looking at the market any at all, because of the possibility of making irrational decisions that can compromise our profitability. So here you can see on the daily chart this movement as it continued in response to this daily candlestick signal. hitting the support boundary the very next day and providing us with this short-term and aggressive trading gain. So in summary, this overall trade was a false breakup reversal where the market was heading back inside of the consolidation and back towards support. This was a situation of an example of a bearish reversal, but of course, as you saw in the graph with the false breakout example, you can also have a situation in which the market reverses bullish and heads back towards a resistance boundary. Double tops on the 4-hour chart in this case are very powerful candlestick signals, and they generally indicate the start of reversals. So having seen the 4-hour chart double top signal, it would have given us a heads up that the market was going to start a reversal and that we should begin to look for the green light on the daily chart in terms of a bearish signal to confirm the continuation of the movement back towards support, and in so doing providing us with a trading opportunity. In terms of protecting your trade, 4-hour downtrend lines are very strong areas to use to protect your trade. If it coincides with a range resistance boundary, even better, because these boundaries also provide protection against pullbacks. And so in this case, the combination of the downtrend line and the range resistance provided a very strong stop loss area to protect our trade against temporary pullbacks. It was also far enough away from the pullback that we saw taking place, so our trade would have been protected from that pullback as well. As I said before, we should never watch our trades because of the possibility of interfering with the trade, because we might see something that is going against our trade, but it may just be a temporary movement against where the market is going to be headed towards, which is of course our trading target. So to avoid anything like that, any situation in which we could be tempted to prematurely close our trade, enter the market, close the trade platform, wait until the holding period has expired, or until you receive an email alert from your trading platform. And finally, candlestick patterns in general are accurate ways of identifying where the market is headed, and use of them and being able to master them is key to long-term trading success, especially when you're trading on the daily chart and the 4-hour chart. So this was a summary of the trade that we were able to capture a trading gain of 65 pips. And so this is how we basically, a perfect example of how we take advantage of false breakout reversal setups, especially when we incur an initial loss in trading the initial breakout attempt. So once we can see that the market is reversing and that we can see a signal that confirms that we are in fact heading back inside of the consolidation, we can take advantage of it and capture a trading gain that compensates for the previous loss and puts us back on track in terms of heading towards our major rate of return targets.